over time, if it is an asset, property, shares, even crypto, if it's truly an asset, over time, you see the power of compounding growth. This is Australian property since 1880. You can see here as compounding growth adds, your return on your original investment is happening. You're generating a return on your return, not just on your original property price. So over time, sure, you have your corrections, but over time, the compounding really starts to take effect. Bitcoin does it, it's a lot more volatile, shorter time frames in Australian property, a lot of ups and downs, and you've got to strap yourself in like a bit of a roller coaster. But there are compounding effects on even that type of asset class. This is the Australian share market from 1920 all the way through to now. You can see the same compounding ramp, okay? The power of this is the exponential growth. Over time, if you'd invested back here, this is where your starting point is. The returns you're generating now are higher each year than what you originally put in, because you're earning that return on returns and not just on your original capital. Okay, so any asset class is really applying the concepts of compounding growth. If it is an asset, if it's not a market or not an asset, then potentially it could go down and never recover. Okay, but some are more volatile than others. Some are more shorter time frames. Okay. Bitcoin's all over the place, up and down. Property, it's a longer game, all right? So why property for me? We have all these asset classes. We can see the curves of them. They all look great. So why would we invest in property? For me, it's about leverage. It starts and ends with leverage. Ask yourself, and I know I've investigated, I've talked to individuals across the globe about this. What other asset class globally will the banks loan you 90% of the value of that asset class to use their money to actually buy it? For that, you have to unpack that in a very short moment. The banks in Australia must have a lot of confidence that the asset price of that is going to be stable. It's going to be rock solid, has low risk associated with the chance of going down. Because they're going to loan you 90% of the asset value, it's a very fine margin there that if the property prices were to go backwards by more than 10%, you're going to be underwater to the bank. And the banks don't like that. One, for you as a person, it's not a positive thing, but for the banks, they don't like that because their money is exposed now, not your deposit. So when the banks are willing to loan you 90% of the value of a property, it means they are very comfortable. This is a safe proposition. It's as rock solid. Now you think this might apply to all property. Well, it doesn't. In some parts of the world, and I've talked to investors, even in Western countries, places like Spain, you'll only receive 30% of the bank's money to buy properties. Okay, think about that. It's still property, but in that country, the financial system, the political system, the property market, and the property as an asset class, it's all not as stable. So the banks have only got confidence to loan you 30% of the value of that property to buy it.